Stay. I'm your host, Sashank. Today, we're diving into a huge shift in the business landscape. Global mergers and acquisitions in 2025 surged up to about $4.5 billion, up nearly 50% from 2024, crossing $4 trillion for the first time in 4 years. As reported by the Financial Times, citing data from the London Stock Exchange Group. Now, that number is so big it almost stops sounding a deal. But the question becomes, what changed? And more importantly, what does a deal boom like this usually signal about where the economy and markets might be headed next? Let's break it down. The comeback story. For a few years, deal making felt cautious. Interest rates rose, markets swung, boards got nervous, and CEOs stopped taking big risks. In 2025, something flipped. According to the figures in their brief, global M&A reached $4.5 trillion, with 68 megadeals of at least $10 billion each. Now, this isn't just a lot of small tuck-in acquisitions. It was the return of bet the company transactions. And whenever a mega deal search, it usually tells you two things about corporate psychology. Executives believe the downside risk is manageable, and they believe staying still is riskier than moving. That's an important mindset shift. It's basically CEOs saying, we don't buy growth, we're just getting kicked out of it. Why 2025 got deal friendly? So why did companies show up again in deal booms? Number one, thriving markets. When the stock market is strong, companies can use their own shares as currency. If the stock is up, acquisitions become cheaper relative to their valuation. In a booming market, boards feel wealthier, investors feel optimistic, and bankers feel it easier, which bold combinations. Number two, obtainable capital. When debt makers are open and credit is available, financing a deal stops being the hard part. Companies don't need perfect certainty, they need funding certainty. And here's a subtle thing. M&A activity doesn't just follow confidence, it creates it. Deals create the appearance of momentum. We're doing something that can attract even more capital. A relaxed US regulatory environment also helps with that. Deal makers are surging the benefits because they're more relaxed US regulatory environment. That matters because the US is still a central court for global antitrust logic. Companies believe regulators are less likely to block deals, they'll attempt bigger ones and do it faster. M&A is partly economics, and the chance of approval goes up, the deal volume tends to surge. Why mega deals matter more than deal count? Here's the reason the 78 mega deals leapt out. The mega deals reshape markers in ways small deals don't. They can redefine competitive landscapes overnight. They can force rivals to respond, often with mergers of their own, and they can set new pricing power in industries. This can trigger cost cutting waves and layoffs because synergies usually mean few jobs. And mega deals also signal something about executive fear, not of recession, but of irrelevance. So, what to watch in 2026? Experts right now are saying that deal making could climb again in 2026. So, here's a few practice signals to watch. Should credit markets stay open? If financing tightens, mega deals slow first. Do regulators stay predictable? Is deal volume highly sensitive to enforcement tone? Do companies keep delivering earnings? With earnings weakening, investors can start punishing acquisition strategies. And the synergies promise to show up in real margins. If not, boards get cautious again when these deals start floating. Because deal booms like this are tied, when it's high, everything looks like it floats. When it goes out, you can actually see what is seaworthy. That's it for today's Business Insights Daily. I'm your host, Sashank. Thank you very much for listening. And the next time you see a merger headline, maybe ask the question that sits beneath all of them. Is this a confident move into the future? Costly attempt to outrun it. Thank you for listening.